we're going to kind of dive into gifted property, but we also have a whole lesson on gift tax. So just keep that in mind. This is something that does have grounds within the lesson on basis and the holding period of assets, but also, again, is much more heavily explored within gift tax. So if this is not something you totally grasp here, well, you're not meant to totally grasp it here. We have a whole nother lesson, but it's something that ties in as well, because also your basis in an asset. What's your basis in an asset when you buy it straight up? What's your basis in an asset when you inherit it? What's your basis in an asset when it's gifted to you? What's your basis in an asset when you get it from an S Corp partnership or C Corp? All great questions, and I'm very glad you asked. So thank you for asking those wonderful questions. We're just kind of touching upon this, and then you will see this again within those specific lessons as well. Now, when a property is acquired as a gift, the cost basis generally remains the same as the donor's basis at the time of the gift. The basis may be increased by any gift tax paid due to the net appreciation in the value of the gift. Gains and losses are calculated using this rollover cost basis, with some exceptions depending on the fair market value at the date of the gift and the donee's future selling price of the asset. Now, generally speaking, you'll see many situations and you just choose the middle, and that's your basis. So if the donor's basis was $28, and let's say it's one share of stock, you are gifted one share of stock. In situation one here, the donor's basis is $28 for the share. At the date, it's one date we're dealing with. The fair market value of the stock trading on the stock exchange is $30. And then the sale price, let's say you sell it that day, is $26. The basis is the middle number. It's the number in the parentheses. This doesn't represent a negative number. This is just me proving that this is what we're selecting. In this case, again, it's the middle number. The fair market value of the stock dropped to 26. The sale price you sold it for was 30. And the donor basis, again, still in the middle. We're choosing that. That's the basis. See again here. Let's say the donor's basis was $30. The sale price was 26. The fair market value is 28. This is the middle number, so we're choosing this. We're choosing this every time. It's the middle number. Lastly, if the donor's basis is the highest amount, fair market value of the gift is the lowest amount. We're choosing the sale price. That is our basis. Super important rule to remember. This actually pops up in a few lessons, mainly because it's kind of important. So make sure you know that for the exam. Again, we will cover it a lot more in depth in the future, but here it is. Whatever is in the middle gets chosen in this particular situation. All right, dealing with some more situations here. Now, sale of gifts at greater price than the donor's rollover basis. This is essentially dealing with what we just saw on the slide, but diving into it more. That was kind of an overview. Now we're dealing into those specific situations. Now, when a taxpayer sells a gifted property for more than the rollover basis, the gain is the difference between the sale price and the rollover basis. So again, this does tie into what we just saw. And as such, remember what we just saw. If you want to pull it up as well, that would be helpful. So in this case, the donor gives non-depreciable property worth $10,000 with an adjusted basis of $8,000 to the taxpayer, who subsequently sells the property for $12,000. What's the basis used and the gain on the sale of the property? Well, simply put, the taxpayer's gain will be $4,000. That's going to come from the $12,000 of proceeds minus the $8,000 in basis. Looking good. Let's keep running through some more situations. Next up, we have the sale of gifts at a price less than the lower of fair market value. This is going to be kind of a loss basis. Well, when a taxpayer sells the gifted property for less than the lower fair market value at the date of the gift, the basis for determining the loss is the fair market value of the gift at the time the gift was given. Again, this is following the same rules that we saw, so it's just the middle amount. The donor gives property worth $10,000, having an adjusted basis of $15,000 to the taxpayer, who then subsequently sells the property for $8,000. Again, what's the basis in loss? Well, the taxpayer's loss is going to be the $2,000. That comes from the $10,000 fair market value at the date of the gift minus $8,000. Now, note that the loss may or may not be deductible depending on the situation. That is a whole other lesson. Actually, we just saw a lesson on passive losses. Got a lot of other lessons dealing with those rules there. Now, a sale less than the rollover cost basis, but greater than the lower fair market value, so in the middle. Now, when a taxpayer sells a gifted property for a price less than the donor's rollover cost basis, but more than the lower fair market value at the date of the gift, neither gain nor loss is recognized. Now, the basis to the donee is the middle selling price. Here, the donor gives property worth $10,000, having an adjusted basis of $15,000 to the taxpayer, who then goes and subsequently sells the property for $12,000. What is the basis in the gain or loss? The solution here: neither gain nor loss is recognized because the selling price of $12,000 is less than the rollover cost basis, but greater than the lower fair market value at the date of the gift, which is $10,000. So the basis is the middle selling price of $12,000. Again, this does tie into that original slide we saw where we're choosing the middle amount. We will dive into this a lot more in the gift tax lesson. Make sure you're familiar with it. If you want to get familiar with it here, feel free. Also, in that other lesson, super important, definitely something to know for the exam. All right, a few more slides on gifted property basis. We probably call it a day on this. Well, when a property is acquired as a gift, the basis for depreciation purposes, if applicable, if it's a depreciable asset, I mean, if it's a share of stock that's not going to be depreciated, that's going to be the lesser of the donor's adjusted basis at the date of the gift or the fair market value at the date of the gift. Now, the amount of accumulated depreciation will then reduce the taxpayer's basis calculated for gain or loss purposes, as we did mention earlier, before determining the actual gain or loss in the sale. Now, a donor gifts a property worth $4,000 with an adjusted basis of $6,000 to a taxpayer. The basis for the property will depend on the selling situation and depreciation. Now, if the property is in a gain situation on the sale, the taxpayer's basis is the donor's adjusted basis, which is $6,000. Again, remember our rules. This is all tied in together. All these gift tax, gifted property situations are following the same rules. Just make sure you're tying them all in together. Now, if we have a loss situation on the sale, the taxpayer basis is going to be the fair market value at the date of the gift, which will be $4,000. Now, if the taxpayer subsequently sells the property for $5,000, which results in zero gain or loss, then the basis is going to be the selling price, which is $5,000. Lastly, for calculating depreciation on the asset, again, if applicable, meaning if it's an actual depreciable asset, such as if you were gifted a car, if you were gifted a piece of depreciable property, such as a building, we know land is not depreciable. Prior to the sale, the depreciable base is the lower of the donor's adjusted basis or the fair market value at the date of the gift, which in this case would be that $4,000. Here's that slide again, just a reminder. Choose the middle amount, the amount in the parentheses. This is, again, nothing different than what we saw earlier. Just a reminder, an important slide to take note of. Now we're going to run through an example of the basis for gifted property. Again, I know we have a whole lesson on gift tax and all of that, but this ties in with basis, and guess what? We're going over basis in this lesson. And hey, it's additional practice. I'm showing much love for everyone here, giving as many examples as possible. So in this example, we see Johnson. Johnson's giving his niece a gift of publicly traded stock with a basis of $25,000 and a fair market value of $20,000. Quite generous of Johnson, so thank you there. No gift tax is paid. Now, the niece subsequently sells the stock for $22,000. We're going to use that thought process of what's in the middle. Let's run through. This situation falls into the exception of the gift tax basis rule because the fair market value at the date of the gift is lower than the donor's original basis. We see that there. The fair market value is lower than the original basis. The niece then sold the stock at a price less than the donor's rollover cost basis of $25,000, but higher than the fair market value on the date of the gift. So it's in the middle. Therefore, there's no gain or loss in the sale. There's a lot to just memorize with this. Just memorizing where the selling price falls and understanding what the tax implication is, what's the basis. That's going to be super important. Again, important for the exam, so it's spread throughout, making sure this repetition is going to help you to memorize this, know what you got to know for the exam. We get another example here. We're going to talk about the gain from gifted property and classification. Now, in this case, a taxpayer received a sculpture valued at $12,000 as a gift. The donor purchased the sculpture 2 years earlier for $7,000 and paid no gift tax on the transfer. Now, this is important, and these sentences that talk about paying the gift tax, but we will go over those in our gift tax lesson. I'm not going to go over that too much here. More so focused on the basis, the gain, which comes from knowing the basis, and then here we'll talk about classification as well. 10 months later, the taxpayer sold the sculpture for $14,000. Now, the amount in classification is going to be a $7,000 gain, and that will be long term. Let's see how we got there. Well, the basis of the property acquired as a gift is the same as the basis in the hands of the donor. Now, in this case, the donor's basis in the sculpture is $7,000. And additionally, the donor's holding period rolls over to the recipient. So, since the donor held the sculpture for 2 years before gifting it, which would make it a long term asset, the recipient held it for another 10 months before selling. The total holding period is more than 1 year. So, obviously, it's very much more than 1 year. And that would make it a long term capital gain when it is sold. Now, when the taxpayer sells the sculpture for $14,000, the capital gain is calculated as the difference between the selling price and the donor's basis. So that's $7,000. 14 minus 7 gives you 7. Therefore, we as the taxpayer have a $7,000 long-term capital gain on the sale of the sculpture. Again, this is important. We want to focus on the basis. Lots of basis questions on gift tax, on normal transactions, lots of different examples. Make sure you're practicing. You'll do quite well. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.